This is related to ACCA, strategic business reporting. Every other session, this is the first session, is right? It will be having a sequence like this. It will be almost 5 topics. I will put it as 1 by 25, okay? And it will go in sequence, because once you are reviewing it, you will not find any difficulty when you are doing this. The strategic business reporting is at the level 3, and it is going to be worked out in section A and section B. Section A consists of 2 questions. One is for 30 marks and one is for 20 marks. Whereas in section B you will have 2 questions. Each consists of 25 marks each. All are compulsory. Is it? All are compulsory. There is no choice you will have. It consists of both the theoretical concepts as well as the applications. And mostly it will cover application in terms of IAS and IFRS. Is it okay with you?
Yes, sir.
Yes. Yeah. Now, this is the most important thing is we should understand the theoretical concepts of IFRS and how these theoretical concepts will be applied and implemented while preparing the financial statements and financial reporting. That is the basic theme, that is the backbone of this paper. Fine. Now, make it a point. You have to divide this very clearly. How much is the theory component, how much is the application component, and we have to be very clear that they will ask us something related to technical articles. Technical articles is nothing but what are the contemporary issues. Fine. The assessment, what I have made my assessment and what is my understanding is around 45% will be a theoretical one, 40% will be application one, and 15% will be the technical articles. Okay, so we have to divide it. Okay, we have to divide it accordingly. Now, we will go by step. Okay, we will see how the things will work. See, very simple and very importantly, how it will work is you should have a basic understanding. This is the very the first one. Is that first we will go a little bit about conceptual understanding, then automatically what we are going to cover in this is we are talking in terms of the conceptual framework. How we are talking about the production of account, how the accounting standards, reporting standards comes into existence. What are the different objectives of financial reporting in terms of information? Definitely, when you are talking about the financial reporting, it will help in the decision making process. And definitely financial reporting is going to be for the stakeholders. We are solely and we are focusing on the external purpose only. Next, we have a basic understanding in the beginning with respect to the accounting and financial reporting, the qualitative characteristics. These things they will not ask us. There is nothing like we have to talk about quality, but these are very important how we are going to apply it. how it is the timely manner, how it is to be understandable, how it is going to be reliable, faithfully presented. These are the things. Next, we are talking in terms of what is the prudence and what is the substance. See, accounting is very sensitive. We have to be very cautious. We have to be very conservative. Is it? We have to be very conservative. That is the reason whenever we are preparing the accounting statements, financial statements, what we are doing two things. One, we are talking in terms of unaudited financial statements. Then we will have a gap. We will have a gap of 4 months. Then we will have a audited financial statements. We have to, why we are doing, we are just verifying everything that we have done. In other words, we are rechecking. Is that everything we have to make sure that we are talking about the measurement. Discuss the high level measurement of uncertainty that can make financial statement less relevant. See, definitely it is when you are talking about the uncertainty, how the things will progress, how the things will have in future. Okay. Now, next, decisions made by the management in terms of, see what happens. When we are talking about the things, there is a different process. Is that there is a initial process at the middle, and process in the end. We are dividing it under 3 different phases. The first one, we are talking about recognition. We are talking in terms of derecognition. Derecognition means whenever we are going to wind up the business. We will wind up the business in terms of, first thing, maybe sometimes we will make a sale of fixed assets. We have to eliminate this from the financial statements. How we have to derecognize it in the middle of the year. Group accounts, is that we are going to sell one of the units, how it has to be done. Those things we will. And definitely the most important thing is how we are going to have a measurement. In this process, most important thing is we should have a very clear clarity with respect to debits and credits. Very clear. The entire things depends on debits and credit. The next, we have, the elements. Elements are nothing but you will have the assets. I know you know this. Assets, you will have the liabilities, you have the equity, you have the revenue or income, and you have the expenses. More importantly, where we have to understand little bit, we have done little bit early, but where we have to understand is everything is done on the fair value. What we are doing in everyday business is nothing but when we are buying and we are selling, we are working on the basis of what? On the basis of fair value. Okay.
Yes, sir.
We will cover the fair value in terms of IFRS, in the context of IFRS. Okay, whatever we are doing, we have to give in reference of IFRS, or we have to give reference in terms of international accounting standard. That is the reason we are talking in terms of fair value hierarchy, how the fair value assessments has to be done, what is the criteria to be fulfilled, and discuss the principles of highest and the best use. What is the most advantage? Definitely we are doing whenever we are in this process, we will take how it is going to be advantageous to ourselves. In other terms, we use something called as opportunity cost, the best available option. And what are the circumstances when entity may use a valuation technique? These are the basic core points. Go by sequence, it will make sense that how we have to progress. If you are jumping in middle, definitely we will not have clarity. Okay, But when we are going by sequence on sequence, we will know what we have done previously and how it is going to be linked to the subsequent topics as such. Is it clear to you?
Yes, sir.
Yeah. What we are doing, we are talking about the wherever it is understandable, I will just go through it. Wherever you need a detailed explanation, I will support with my discussion. Now we are talking about the conceptual framework of financial reporting, and these are the two things. The first one is what is the conceptual framework of financial reporting, and most important thing, we are talking in terms of fair value. Okay. Now we will now cover this conceptual framework. Use the board how we have working with IFRS or IAS, and by preparers of financial where notes. In some cases, what will happen? In some cases, we will not have a much clarity. Okay, much clarity. Where we have the clarity, we follow this. See, that is the reason. What happens? The financial accounting, in most of the cases, we are talking in terms of assumptions. Wherever you have, they see first what they will mention, they will give you the methods. Okay, you will have like depreciation, you have different methods. Fine. Inventory, is it? If you take depreciation, you have different methods. If you take inventory, you have different methods. Is it right? If you take fixed asset, property, plant and equipment valuation, we have a different methods. Is it? In different methods, you can choose a method which is more appropriate for you. When you are choosing the method which is more appropriate for you, we have to think about the assumption. You can make an assumption that I am making this, I am selecting this method. Is that once you are having the assumption, definitely you can have your own way of work. That is why in some cases they will not be there. But wherever is not there, wherever you have any little bit of doubt, see, marks will be given for this in terms of assumptions. You put the assumptions, definitely they will not decline it. Is it right? Next, coming back to this is the first thing, the most important. Write down on the separate page as is that you have a fair value measure. This fair value measurement almost we are going to cover in every lecture as such, more or less. How we are using this is what it says. Fair value means at the time of execution. Is it at the time of at the normal trading situations? Normal trading situations, what is the value? That value will be executed. Because nowadays, in most of the cases, what is happening? There is an online buying and purchase. Is that when you are saying it's a fair value? It is applicable to all people. There is no discrimination as such. Is that these are the things we will cover. Next, you have seen the content. Fine, good. What is the importance of financial framework is you are talking in terms of the principles and concepts. Right? So a good financial framework means a strong financial framework means there are principles in place where all our future accounting standards will drive. It is a difference point for the preparation. Is it? What is the thing we are talking about? The background, we are talking about the financial information, and so on and so forth. What is the purpose? Is that the purpose is to assist the board while developing the standards. Is that there is one board which will universally all over the world, which will make the financial reporting standards. Is that we are talking about another thing? We are talking about preparation of the financial statements. When no IFRS standard applies, particular tax or when a IFRS standard offer a choice of accounting policy. See, it's nothing but the accounting policy is which method you should apply, how it has to be processed, and most importantly, it will going to assess to whom it is going to assess the stakeholders. Now, what is the objective of? See, this is the basic thing. The objective of financial reporting is to make decisions about providing economic resources. This is what we are doing. Is that when we are talking about when we are discussing about preparation about the financial statement, based on these financial statement, we should be in a position to make it decisions. Of which type of decision? Economic decision. Economic means definitely it involves what? It involves cost and benefit. Are you clear about this?
Yes.
Fine. Yeah. Now, what are the, if investors, how the decisions will work? Their decisions will work with future. This is all we are doing in subsequent chapters. Okay. We are talking in terms of future cash flows. We are talking in terms of the management or the people who are the custodians of the assets of the company. Okay. The management or the custodian of the assets of the, they will take into consideration how best we are going to use the assets, economic resources, and how the future cash flows we have done. If you remember, we have done the concept of future cash flows. Future cash flows, we will also discuss this one in terms of how we are thinking about the assets, how we are going to make use of liabilities and equity. And if you take these 4-5 into consideration, these are going to be called as elements. They are going to be called as elements. Now, what is the sum? This is a measurement. We are talking about definitions, elements, recognition, and this is a summary of this. Is that, keep it in mind. I am putting a star here, okay, and wherever is applicable, I am going to use what I am using the purple color. Okay, when I am using the purple color at the time of revision, you have to focus on these things. Yeah, you have to focus. Means it gives you a very, very brief and immediately. You are not supposed to waste any time on that. Automatically, you are talking about the element. It should come into your mind. Yes, elements are 5 elements. Recognition and derecognition, how it is going to evolve. Useful information. We are talking in terms of what? We are talking in terms of other comprehensive income. Is it clear? Means it will give you, we are covering this into consideration. Now, when you are talking about the qualitative part, do you have done this? Just I am not going to take much time on that. It has to be relevant, is right? It has to be faithful. What the faithful consists of complete, is that? Faithful consists of complete. It has to be neutral. It has to be free from error. Is that? Now, what we are using the concept of prudence. Prudence is make the sense. Is that when we are talking about the prudence, we have to be more conservative. Prudence means the assets and incomes are not overstated and liabilities and expenses are not understated. Neither you have to overstate the assets nor you have to understate the liabilities. That is the basic thing, because when we are making preparing the financial statements, there is every scope. You have the choice that you can overstate the assets. How you are overstating the assets? That's very important. Is that overstating the assets? When you are going to overstate the assets, what we'll do? We see in simple concept, you have a depreciation. Is right? When you have the depreciation, in depreciation you have a straight line method. You have a return down value method. Straight line method, the amount of depreciation will remain same all through the years, 1, 2, 3, 4, 5. Return down value method, what will happen? The amount of depreciation will decrease as the number of years will increase. Okay, this is a small example I am giving you. Now what happens? What they will stress is that there should be a consistency and there should be a comparison. This is what we are talking in terms of IAS 1, preparation and presentation. Preparation and presentation of financial statements. You should have consistency. You cannot change one method to another method as you wish. Is that? This is the things we have to take into consideration. That is the reason you have to be very careful. You change from one method to another method, definitely there is a possibility that you can overstate the profits, you have overstate the assets, or you can understate the asset. Similarly, in terms of liabilities. Yeah, that is the reason when you are talking about the prudence, is it? Again, I am giving you a one. What they say, they are talking in terms of IAS 37. Provisions, contingent liabilities and contingent assets. Is it clear to you?
Yes.
Okay. Now see the thing. Now you the moment you refer these things at the time of revision, you will have more clarity. You don't need anything else. Is that what are the enhancing? What we can add something more? Is that you should have a comparability, timeliness. That is the thing. Older information is less useful because it is a historical cost. Historical accounting concept. Is that historical? I will put it as like it is a historical accounting. Now we are in the year 2023. Okay, maximum for you the information is relevant for 2022. Is that you cannot say that I am going to have the information which is related to 2017, 2018, 2019. See, 2017 is it's a old dated. The rule says that when we are taking the historical information, maximum how many years we can take maximum for last 5 years. Is it? It is, that is why we are mixing something with respect to the financial accounting, something with respect. If you go to the banks, what the banks will do? The banks will ask for the company's last 5 years. For the individual, they will ask for the last, for the individuals, they will ask for the last 6 months. That's all. As simple as that. They are not going to go beyond that. Okay? That is the timeliness. Older information is less useful. Next, when we are talking into verifiability, that's very important. Is that when you, without any evidence, we will not going to have any acceptance as such, and it should be understood. It should be very clearly and concisely, as we should not give. That is the reason what we are doing. We are talking in terms of summary. We are giving. See, what we are doing. We are giving supporting the financial statements with the notes to the accounts. Notes to accounts is nothing but a brief summary what we have done. Fine. Now this is what it says. You are talking about cost constraints also. Is that we are taking into consideration that it takes producing financial takes time as well as cost. Is that example? Here we are talking in terms of IFRS 16. We will cover to this. Is that it is too early to talk about this. Very too early. But keep it in mind. IFRS 16 talks about the leases. Is it? It's very too early. Next, we have done this financial statement in terms of elements, and we are talking about the financial statement in terms of the financial position, financial performance, and you are talking in terms of cash flow statement. That is why we call it as a three piece. Is it? When we are talking about the first one is the position, the second one is the performance, the third one we are talking in terms of prospects. Are you clear about this?
Yes.
Any doubt anywhere, you just stop me. Okay? Anywhere you have all the liberty. Okay? Now we are talking in terms of reporting entity. The reporting entity is one. We are going to who is going to prepare the one who is prepared the financial statement. Elements of financial statement. That's what it says. Is that this is very important. People will say that what is an asset? Asset is nothing but what you own. Liability is nothing but what you owe. Is that is the basic, that is the initial fundamental starting when we learn this. But what is the asset is? Asset is nothing but the present economic resources controlled by the entity as a result of past event. This is a basic explanation for an asset. Whereas in terms of a liability, it is an obligation to transfer economic resource as a result of the past event. Is that asset is nothing but what you are investing now. Is that you are investing now and you will get benefit in future. Whereas you will get benefit now. You are taking a loan, is it right? You are taking a loan. When you take the loan, what will happen? You will get the benefit now, but you pay in future. Yeah? Equity is the residual interest. See the thing, this is very important. We are talking in terms of equity. What you are doing, we are adding, what we will add, we add retained earnings. Is that we add retained earnings. What is the components of, we have the reserves. Is that what is the component? We have the reserves. See, when you are preparing a income statement, is that when you are preparing an income statement, the last thing what will be there in the income statement is nothing but after paying the dividends, we have the retained earnings. These retained earnings we are going to add up to whom? We are going to add up to the equity. That is the reason what we say that it is the residual interest. We have the income, we have the income is nothing but, see what happens income? Income will increase in assets or increase in assets in terms of profits, decrease in assets in terms of losses. So, whereas see the thing, expenses are decreased. Expenses definitely, if your expenses are increasing, your cash will decrease. Is it right? If your expenses are increasing, what will happen? The cash component will decrease. Whereas increase in the liabilities as a result in decrease to equity. Definitely, what will happen if your expenses are increasing? Be very specific. If your expenses are increasing, what will happen? The profits will decrease. If your expenses are decreasing, your assets in the form of cash will decrease. Other changes are economic claims in terms of contribution from distribution of equity holders. Is it? In terms of what? In terms of dividends. Is it clear to you?
Yes, sir.
Now, what is the economic resource? It is a right that has the potential to produce. See, this is what it says. Economic resources, you have the assets. Is it? When you have the assets, it should see what is the another explanation of the asset. Another explanation of the asset is it should generate revenue. You have the assets, but it is not generating revenue. There is no purpose of retaining those assets. There is no purpose of, there is no meaning. If you have land at some place, if you have buildings, if you have buildings, and it is not generating, it is not having any commercial value, then what is the purpose? You cannot, it has to generate revenue, and in future the value should increase in terms of wealth. Then only we can make it is a potential. It has right that has potential to produce economic benefits. Okay. Next, in terms of recognition, meet the one of the elements. The elements are recognized. Provide users with useful financial information. It should be, when we are talking about recognition, it should be relevant information, and it has to be faithful. They have given another one. Okay, they have given another one of what? IAS 31. These are all introduction. Okay, I'm not going to go in detail, but subsequently when it is needed, I will put it. I will give you the complete explanation about with what IAS 37 talks about. IAS 37 talks about the provisions, contingent liabilities, and contingent assets. See, entire the things is with respect to this. Okay, are you clear about this?
Yes.
Now, see, test your understanding. This makes real difference in our approach. Is that people will skip this. The bottle operates is a published industry. The bottle brand is highly respected, and as a result, the books published by the bottle receive extensive coverage, both online and in national and international press. They are published. They are book publishing company. They are getting they are publishing the books, and they will get a good online and national. The brand is internally generated and in accordance to IAS 38. See, it is very, see, now we are say you are talking in terms of IAS 1, you are talking in terms of IAS 37, is it? We are talking in terms of IAS 38. IAS 38 talks about what? Intangible assets.
Assets.
Discuss the extent to which accounting treatment is consistent with the conceptual framework. It's an intangible asset, is it right? It is an intangible asset. Just read once within very quick time from your own. I will just give you 1 minute time. Just go through it.
Okay. Yes.
What they say, it is consistent with the financial framework. See, when you do the things, keep it in mind. It is having a potential. It is having the potential to for potential for future economic benefits. Now, what happens? See the thing. When you are doing the things, definitely we know, but is there any evidence is there? Is it any relevant information is there? It is the relevant information is missing. It is based on what? It is based on assumptions. Is it? It is based on assumption. If it is based on assumption, definitely it will be a question mark. Fine. The rule says that it should have the conceptual framework says that one first condition is meeting, is that? The second condition is it should have, see, very important. These type of questions they will ask somewhere in theoretical ones, and the moment we start doing the questions, we will come across what is the criteria of intangible assets. Is that it says that it's only be recognized if there is provided relevant information. Now, or you should have a faithful representation. You should provide. That's very important. Is that you should have a faithful representation. And see the things what we have covered till now. What they are saying that it will have both online and national and international press. The brand is internally generated. You focus on this one. Intangible assets says that IS 38 says that anything which is internally generated will never be recognized. Understand? This is the one blanket condition. Okay. Internally generated is going to be not reliably measured. Not. And internally generated intangible. This is the first time you are learning this. internally generated intangible assets will never be there. Okay. Now, you what it says that is that it should only be if there is a provide relevant information of faithful representation. Next, are you clear about this? Next.
Yes.
Here also another thing what it says, fair value, is that the fair value of the brand is also difficult, because what happens is the fair value is very unique. Brand value, is it right? Brand value is very unique. Brand value is very. Now the point of discussion is this: these are qualitative. This is quantitative. This you can measure future economic benefits. Yeah. Now we have to think with respect to conceptual framework. Conceptual framework says that any asset which you are having a potential for future economic benefit, that has to be treated as an asset. In this situation, discuss the extent to which the accounting treatment of the bottle is consistent with the conceptual framework. It is consistent with the conceptual framework because what happens? It gives the potential for future economic benefits. Quantitative have more weightage, qualitative is having little bit less weightage. Are you clear about this?
Yes.
Is that? See, now it has been explained. For now, in next stage, we don't need any further explanation. What are the things you should keep it in mind? That assets should have future potential economic benefits. Intangible assets, these are the key points. Internally generated, whichever subject you take it, whichever subject. Internally generated intangible assets is not reliably measured. Externally, now you come to the external. Externally means you are buying some shares, is it right? What is the basic definition? You are talking about the market value of the shares minus purchase consideration. It is going to be called as a goodwill. Is that market value minus goodwill is measurable? Is that goodwill is measurable, and that is the reason we take goodwill in the financial statement. You will never come across anything. See, you will have trademarks, you will have copyrights, you will have patents, but till now we have not calculated what is the value of patents. We have not reflected. Is it right? How we have calculated and how we have reflected. Are you clear about this?
Yes.
This is the reason. See, every lecture will have test your understanding. Test your understanding, you just analyze it in detail. Automatically it will give you a substantial knowledge, so that how we can treat it. Okay. Next, derecognition. Derecognition is what? When you are losing the control of the asset, you don't have any present liability. Using the control of the asset, definitely you are taking the lease automatically at the end of the lease. Either you are taking, likewise, either you are transferring the assets. In terms of what? You are transferring the asset. The asset is the aircrafts. Is it that aircrafts? You are taking the aircrafts, and what will happen? The lease of the aircrafts will be completed. Okay. Next, consumed components. Is that consumed components? See the thing. I will give you you are talking about an oil well. Is it right? You will have the resources. Is that once oil well is explode, what will happen at the end of its exploration? The value of the oil wealth will become zero. Is that those are the things which you should understand how it will work. Recognition, a gain or loss on the above whenever you are transferring, when you are selling, and recognition if there is any retained component. Recognizing any retained. Means this is what we will cover this again in detail. What it says, see the thing. The entity sells how much? The entity sells 2 million, and retains the right to buy back at 3. Is that we are selling it, and we have the right to buy back. Is that right to buy back? See, if you take most of the cars will do this. Is that most of the car dealers will do this? What they will say? They are going to say that we are selling a car for, and it will be for 4 years. And after 4 years, if you want to sell it or you want to replace the car, come back to us and we will buy back. At the time of sale, the building has a fair. Now, when you are talking about the thing, the right to buy it back at what level? At 3 million. Okay. Now, but at the time of sale, at the time of buyback, the value is how much? The value is 7 million. Is it? Now what happened? That is very important. When you are talking in terms of this selling at 2 million, you have the right back. Means this is still in the contract. Okay, this selling of 2 million is still in the contract. That is what it says. The cash which you are going to receive, the cash received will be recognized as a loan liability, because maybe he will sell you back or he will not sell you back. Till the contract is not executed or completed or not expired, the cash which we are receiving is the part of the contract, and we are supposed to oblige this. If that is the case, then we have to treat it as a liability. Then only we have to de-recognize. Is right? This is what a simple basic concept of de. It is very initial stages. Just we will hold it for a while. When we will do, we'll cover in detail. Okay? Are you clear about this?
Yes.
Next. We are talking about, say, financial accounting is very simple. We are talking in terms of the historical cost, and we are talking in terms of current value. This includes what? This includes fair value. The first thing that almost everywhere, the fair value, value in use, and what is the current cost. See, first thing is fair value at the time of selling. See, sometimes what will happen, you will have the fixed assets, you will have the depreciation. In financial account statements, we show like this process. Then whatever the value here, that is going to be identified as value in use. Current cost is used whenever there is a replacement. See, everything is very clearly defined. We should not have any confusion in understanding the concept. The moment you say fair value is whenever there is a buying and selling. Value in use is how you are going to show in the financial statement. Current cost is nothing but when you are talking in terms of replacement. That is the selecting a measurement basis, fine. Okay, we'll cover this. Another one. Yeah, this is, now you see the thing, you have investment property. See, and this is the process, is that when you are talking about property, see, property and plant and equipment is different, investment property is different. Okay, property, plant and equipment talks about IAS 16, investment property talks about IAS 40. When you are talking about investment property, which generates revenue for you, okay, there are two things. One is we are having a fair value model and we have a cost model. When you use fair value model, when we use cost model, it's whenever there is intent to sell the asset, then in that case we use fair value. When we have no intention of selling the asset, then we use when we are using it for a rental income generated, then we are using the cost model. Okay, so this means only, see, if you are talking about IAS 40, this is a broader framework, isn't it? Then they will ask you questions within this only. Okay, in terms of presentation, is that we are talking in terms of presentation and classification of assets, liabilities, in terms of separate component, or in terms of classification. See, when we are doing the things, you are talking about the assets, is it right? When we say it is assets are we are talking in terms of tangible assets, we are talking in terms of intangible assets. Again, in tangible assets, we are talking about non-current assets and we are talking about current assets. Fine. Again, in current assets, we are talking in terms of liquid assets. You have these types of very basic classifications. Is that what is the classification? See the thing. And at a reporting date, bottle owed 10 million to a bank. 1 million of this loan is due for repayment within 12 months and is presented as a current liability. The remaining 9 million is a non-current liability. Understand? Now you can say, when you are talking liabilities also, that's what it says. You are dividing it. We are saying what is the element of current liability and what is the element of non-current liability. You know this, but even after that, I'll just say, if it is less than 1 year, it is a current liability. If it is going to be more than 1 year, it is a non-current liability. In the same way, they are talking in terms of the 3 million of account held in the bank, they earn 5% interest. They have 1 million overdraft in the account that incurs 10% a year. Ellipse must not offset 3 million with 1 million. It cannot show 2 net million cost. See what happens? No way. See the thing. These are the, if you go back to our basics, what will happen in some cases it happens is that you will have a cash balance, as well as you will have a bank overdraft. Ellipse must not offset cash balance with 1 million. It cannot show 2 million net current asset. The cash balance and overdraft have different characteristics and risk. Separate classification provides relevant information. Get the thing? You should not say that it happens, is that you will have cash and bank balance and you will have the overdraft. You cannot say that there should be a net difference. Now this is you know this, but the details first time you are going to cover here. Sometimes we will have an aggregation of adding together of the item. Sometimes we have the segregations. Okay, profit and loss. Again, now, if you take the income statement, we'll cover this again. Say income statement. We will have all the things. We will have sales. We are talking about so many other things. We will take. We will have some income which is going to be added. Some income which is going to be recovered. This is from the business, operating from business or These are from operations. Something we are talking in terms of not from operations, from other comprehensive income. Yeah, other income, not from operation. The rule says that we have to show it separately. What is the operating income and what is the non-operating income? That is the next total comprehensive income. Very important, very specific. The moment you will add up from one classification to another classification, it is a basic fundamental error. Just go through this, test your understanding too. Read, just for your read, just roughly you read how it will work. Cryptocurrencies are digital currencies that operate independently of the central bank. Some businesses now accept cryptocurrencies in place of traditional. The market price of key is highly volatile. Investors can earn large returns by buying cryptocurrencies on an exchange when the quoted price is low and selling at an exchange when the quoted price rises. Cryptocurrencies have proved problematic with regard to financial reporting because they do not seem to fall within the scope of IFRS or IS. As such, preparers of financial statement must see conceptual framework. That provides useful information for the using the discuss how the entity account for investment in the cryptocurrency. We have any standard or anything for cryptocurrency? No. It has the potential for economic benefit. As per the conceptual framework. It has any potential for a future economic benefit?
Yes.
Is it? It is having a future for the economic benefit.
Hello?
Yeah?
Yes, sir.
Is it? No. Is it? It doesn't have any just I'm giving you time to understand, okay? It doesn't have any IS and IFRS. Now, can we identify this as an asset?
Uh, yes, because it is something that we control.
See, what
We
will
own it.
happen? The prices are volatile. Is that the prices are volatile? When the prices are volatile, there will be profits or there will be
Yes.
loss. Is that there will be profits? See, See, is it? Now, see, using the conceptual framework, discuss. We are not going to make a conclusion how the entity might account for investment in cryptocurrency that it holds to trade. Is that we are just making a discussion on this. It is when we are going to be say that either it will be an asset or it has the characteristics of an asset. Is it right? It has, if you borrow cryptocurrency, it has the characteristics of a liability. If you own it, you have the, if you are owing it, it is a characteristics of a liability. Is it? Now, when we do the things, these are the things, these are the points which have to take. It has the potential for future economic benefits. It has the prices are volatile, where we are getting profits or losses, and most importantly, if you own it, we can characterize as an asset, and if you owe it, but technically speaking, there is no reference in the this is going to be a contemporary issue. Please refer, okay? Please refer the technical articles on this. Is it on the ACCA website? You will get more clarity on that. Weekly basis, spend half an hour, not more than that. Half an hour on the technical articles. Just read as you are reading. Don't just initially you don't need to take any notes also, but you read. The moment you read, any further discussion in our sessions, it will give you a more clear understanding. Okay. Now, compared to the coming to the criticism of financial reports. See, financial reporting have limitations. Okay, it is having lot of limitations. As simple as that. Yeah, it has lot of. They say that it is going to be based on the principles. It is going to be based on the historical information. Is that it is. No, as a result, new forms of non-financial reporting has been emerged. What is the new forms of non-financial reporting? Any idea?
Yes.
You have environmental reporting, environmental accounting, or environmental reporting. Is it right? You
Sustainable accounting?
Pardon?
Sustainable accounting?
Sustainable accounting. Social responsibility accounting. Yeah, social responsibility accounting. Environmental accounting is taking precedence nowadays. It's taking a precedence over others. You have to submit environmental accounting report as part of your financial annual reports. Is it right? Now, that's the thing. Is that in terms of historical information, in terms of unrecognized, some assets and liabilities are not recognized in the financial statements. See what we don't recognize. See the thing again. There now you will understand, such as internally generated goodwill. By revising, by studying initially, and by coming across and having second time, third time the same point, we will get convinced, and it will be there in our mind that yes, internally generated goodwill is not recognized. A company reputation of employee skills play a pivotal role in the success, but this is not. This is an unrepresented in the financial statement. Yeah? Your employees, see what happens. Employees will be matched with what? Employees will be matched with the salaries. Directors will be matched with the remuneration. Fine. We will not going to have. We cannot measure that what is the skills of the employees, all those things. Is it? That is the one of the limitations. Keep it in mind, very important. It is, what are one of the limitations are historical information. The second is it is generality. It is a clutter. Have a criticized. We are becoming increasing clutters of extensive disclosure requirements. We are talking that disclosures can be very generic. See, when you are disclosing, it has to be very, very specific. What is the limitation? Current and past profits and cash flows are not only determined for future success. Yeah? That means you will have long-term success is also dependent how it is governed. Yeah? This is one of the financial statements are prepared in accordance with the IFRS. Say little about these areas. We have see, they have given a framework, that's all. Then we are not going to say that it is going. They gave us a boundary as such. And financial reporting uses many estimates in terms of depreciation. It's an estimate subjective, and in particular, they are talking in terms of as the nature of estimates reduce comparability. These are not people see when we are talking about financial accounting limitations, we have to be very specific in this area. It is talking in terms of professional judgment. This is one of the areas we take into consideration the historical cost. You have bought one asset in 2018, still you use the asset for the depreciation calculation. But if you take the same value of asset in 2023, the value will be more. Definitely the depreciation will, most importantly, the contribution to revenue. Is that a new technology is there? You comparing with old technology and new technology will be, when we are talking about new technology will be more productive. Is it right? More productive. Is that more profitable? Is that more profitable? And it is more cost efficiency. Automatically, is that this is one of the limitations with respect to the history. The policy changes. Some standards such as IAS and IAS 16 and IAS 40 allows us to choose between cost and fair value. That means definitely when we have if you take IAS 40, you have fair value model, you have a cost model. Coming back to this, see, revise this once class is over, okay? Because the moment you go to the next session, definitely I will give reference to the things what we have done in the beginning. Is that the first lecture is very, very important. Yeah, what is the objective of IFRS 13? Okay, IFRS 13. This is the first IFRS we are covering. Okay, it says come back to here. First we'll do this. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between the market participants. That is what it says. They are talking about what in terms of fair value. It provides a single source of guidance. Very, very important. More accounting standards at the fair values. We are talking in terms of IAS 16, which allows entity to measure at fair value. We are talking about IFRS 3, business combination. When you are talking about the business, this relates to what? This relates to the group companies. One question will be there on this, in a way, one dedicated question. Okay. When you are talking about the group companies, definitely what will happen? You will have the parent company, you will have the subsidiary companies. Whenever the subsidiary company financial statements are going to be consolidated, it has to be done on the fair value basis. Keep note, it does not apply to whom? It does not apply to share-based transactions, and it does not apply to IFRS 16. They have three approaches. See, very, very simple. Now we are slowly moving from the basics to the advanced level. Do the SBR, what SBR expects from us. Is that we are talking in terms, when you are talking about the IFRS, you have a market approach, point number one. You have a cost approach based for the we are talking in terms of valuation based on the recent sale price. We are talking in terms of replacement cost approach. We are talking income approach when we are talking in terms of financial forecast. Whichever is taken, the aim is always same, to estimate the price that will be transactions with the market price. This rule will apply, okay, within the framework of this. Is that within the framework of this will apply. Means it have a situation as such. The fair value is read this, okay. The fair value is the market-based measurement, not in terms of entity specific. They are given three things. One is the equity shares, one is the building held for use, and one is a cash generating units. This is also one thing which we will cover. Is it right? CGU. Right? Cash generating units is a new topic. We will cover this. Okay. Now, baklava is it clear for you till now?
Yes, sir.
Any doubts anywhere? Just let me know. Okay. Baklava has an investment property IS 40 that is measured at the fair value. This property is rented on a short-term lease. The director wished to fair value the property by estimating the present value of net cash flows. The property will generate. They argue that the best reflects the way which the building will generate economic benefits for baklava. The building is unique, although there are many sales of similar buildings of the local. Discuss. See, one thing I want to tell you in the beginning, what is the requirement? That's very important. If they say explain, you explain it. If they say discuss, discuss it. If they say describe, make a description. If you say yes, identify whether it will fit. If you ask some opinion from us, then only give opinion. If there is a discussion, just you have to be very, very limited to the word which they are using. Put on the discussion only. Don't give your opinion. Is it? The valuation techniques suggested by the directors comply with IFRS standards. Is it? ISRF talks about IS 40. Is it right? And here IFRS 13. Two things are integrated. One, we are talking in terms of IS 40, and now see where we are fitting it. Is it right? They are talking in terms of property. This property comes in which level? Property comes in level. Is it? Property comes in. See what they are saying. This property is rented out of the short-term leases. Is that this property means they are held and used. Is it right? This is with respect to level 2. It is held and used. Is it? It is held and used. Fine. When it is held and used, is it? If it is held and used, 1 minute.
Okay.
Is it? If it is held and used, it is here. But what happens? See the thing. It is also rented. The directors wish to fair value of the asset by estimating the present value of net cash flow. If you go by the first one, it comes in level 2. But if you go from the next paragraph, what happening? The directors wish to fair value the property by estimating the value of net cash flow that the property will generate. When the property will generate, this is going to be identified as a cash generating unit. Are you clear about this?
Yes.
Okay. But see, you have to give the arguments how it is. The building is unique. Also, there are many sales of similar buildings in the local area. Which that means what happening? If we are talking in terms of sale, is it right? If you are taking the things in terms of sale, it comes in level 2. But if you are talking in terms of rented property, it comes in level 3. Means you have to say, if it is related to cash generated units, it is in level 3. If it is held and used, it comes in level 2. Means you have to give the explanation how it is related to level 2, and you have to give the explanation how it is related to level 3. Is it clear?
So what is level 1?
Level 1 is for equity shares. Is it? Level 1 is for the equity, very, very specific. Level 1 is for the equity shares, level 2 is for the buildings held and used, and level 3 is cash. If the moment it is, we are talking in terms of, read the thing. An investment property measured at fair value. This property is rented out for a short-term lease. Is it? Rented for a short-term lease. If it is rented for a short-term lease, it is generating cash for you. Is it right? It is generating cash from you. When it generates cash from you, it is going to be identified as a cash generating unit. That is the future cash flows. The directors wish to fair value the property, the present value of net cash flow that the property will generate for Bakla. They argue that best reflects the way the building will be generated few economic benefits. Now you see the thing. If you are doing the things, we are coming within the conceptual framework, is it right? We are coming within the conceptual framework and potential economic benefits. The one is potential and economic benefit. But we are at the advanced stage. We should classify whether it is level 1, whether it is level 2, or it is level 3. Whenever you are talking in terms of future cash flows, it is going to be identified as a cash generating unit. Is it okay with you?
Yes.
Keep it in mind. Next, again, when we are doing when we are going to do the next one, you will have more clarity on that. We are talking in terms of IFRS. What it says, they are having the price received when the asset is sold. It is a principal market. It says that it is measured by reference to what is the principal is the market with the greatest activity for the asset. See, very simple, as simple as that. Is it right? You understand the things. Weekend. Is it right? Weekend sales will have the highest activity. Got my point? Weekends, during the weekends you have highest activity. During the festival seasons you have the highest activity. That is the principal
Yes.
market. Is that people will seasonal market, is right? That market has to be identified as a principal market. Entity must be able to access principal market at a measurement date. That means that principal market for the same assets can differ between entities. You have automobile market will have a different principal market. You will have electronic products will have a different principal market. Likewise, every market will have a different principal markets where there is a highest activity that's going to take place. This is one of the conditions of IFRS 13. Because why I am discussing is, they will say that this product is not actively traded. If this product is not actively traded, automatically we should not identify it with IFRS 13. If there is no principal market, then fair value is measured with respect to the what is the most advantageous market? That maximizes the net amount received from the selling of an asset. Means you have two things. One is we are talking in terms of the principal market. One is we are talking in terms of most advantageous market. When we do this one, you will have more clarity on that. Can I start this one?
Yes, sir.
Just go through it. Just I'll give 1 minute time. Just.
Okay, sir.
See that. See this is what we have done. We have taken the principal market, advantageous market. We skip this one. See the thing. Transaction cost will play a role in deciding which market is most advantage. The fair value is not adjusted for transaction cost because they are a characteristics of the market rather than the asset. We have not covered one point. Definitely we cannot go further away. Is that what is the transaction cost? Is that will play deciding which market is. However, fair value is not adjusted. See, what is the transaction cost? Get me. You want to sell an asset, is it right? You want to sell an asset. If you sell the asset directly, principally, with is our assumptions, is it right? If you are selling an asset directly, is it right? There is chance of getting a lesser value. If you are selling an asset through a middleman, there is a chance of getting a higher value. Transaction cost is such as legal or brokerage fees. Fair value is not adjusted for transaction cost because they are characteristics of the market rather than the asset. Is that what is the transaction cost. Transaction cost is the characteristics of the market. Is that fair value is not going to be adjusted according to the market. Fine. See, now I will just make it a point. What is the principal market and what is the advantageous market? If there is no principal market, then fair value is measured by reference to the prices in the most advantaged market. The most advantaged market is the one that maximizes the net amount received from the seller on selling of an asset, amount paid to transfer the liability. Fine. Now, if an asset is sold in two different active markets, an entity enters into transactions in both markets and assess the price in those markets measure on the measurement date. Is that market 1 is the principal market. No principal market can be determined. Is that market 1 is the principal market. Is that what is the second one? No principal market is defined. If market 1 is the principal market, what the principal market says, go back. Where the greatest activity is there, where we are going to, this means that the principal market for the same assets can be different entities. We have the greatest activity of the asset in that market. Okay. Now, what is the fair value with respect to the what is the price? Price is going to be 26. Is it? This is with respect to market 1. Is it right? Price is with respect to if it is a fair market, we are ignoring what? We are ignoring the transaction cost. Is it right? We all exclusively transaction cost, because transaction cost will play a role in deciding which market is more advantageous. In the most advantageous market, we will take transaction cost. In the fair value is not adjusted for the transaction cost, whereas principal market is based on the fair value. Okay. Now, you see the thing: less transport cost. How much is there? It is 2. This is going to be fair value. Okay. Now, this is the first one. If you say if you compare market 1, no principal market can be defined. Okay, market 1 and market 2. This is point number A. This is point number B. Okay, point number A. Net price received. Is it right? Net price received. How much is the net price received? Market 1 is 21. Market 2 is how much? 22. Is it right? Market 1 is how much? 20. Most advantageous market. Is it right? If you no principal market is defined, if you take the most advantageous market, is it right? Most advantageous market is nothing but I will put like this, is that most advantageous market, where the price is maximum. Are you clear about this?
Yes.
Is that where the price is? Now, if you compare it, is it right? If you compare it, this is the first level. Okay, this is the first level. If you compare with the fair value, is it right? If you compare with the fair value, how much is the price? If compare with the fair value, what is the price? Fair value is, price is how much? Price is 25. Transportation cost is how much? Transportation cost is 2. It comes to how much? 23. Is it? It comes to how much? 23.
Yes.
Are you clear about this?
Yes, sir.
Is that, see the thing, the purpose of doing is, if you take the principal market, if you take the most advantageous market, if you take the transaction cost, how the transaction cost plays a very significant role. Is that how the transaction cost plays a very significant role? If you see the thing, if you take the transaction cost, we are paying 3 transaction costs. But what will happen? Here the value is at the maximum. You pay less brokerage fee, your sale value will be less. Is that? This is one area. Yes, tell me please.
Nothing, sir.
The second point, you see the thing. If you take only the primary market, how much you are receiving? You are receiving a lesser price. Here you are receiving a most advantageous position. You are receiving a higher. What you should keep it in mind is the difference between the principal market and most advantageous market, IFRS 13. In the principal market, what is the fair value? In the most advantageous market, what is the fair value? When you are talking about the most advantageous market, we have to take into consideration what? The basis will be net price received. Is that? If you are taking the principal market, we have to take the fair value. Is that? This is the differentiation. This is the one of the part of the main questions. Is it okay?
Yes.
Lit-
So for B the answer is market 2.
Pardon?
For B the answer is market 2.
Yes, for B the answer is market too. See here, see why we are done. Here we are talking in terms of what? In terms of the fair value. Is that? If you take into fair value, where the fair value is high, in the fair value is there in the market 1. If you take the question number B, where is the most advantageous market, where the value is high.
Okay.
Okay? Means definitely this is the differentiation we should understand. That what happens in case of fair value and what happens in terms of what happens in terms of the principal market and what happens in terms of most advantageous market.
So in most advantages, even transaction cost is adjusted.
Everything is adjusted here. Is that? Everything is adjusted here. Is that? You have a transaction cost, 20, you have a transaction cost, you have a transport cost also.
Yes.
Is that? Everything is adjusted here with respect to the most advantageous market.
Okay, sir. Yes.
What is the net result? That's most important thing. In terms of the second part, is it right? In terms of, they say that we are going to cover in terms of non-financial assets, we are going to cover in the chapter 12. Okay. What are the financial? You should have a contractual rights. you have investment in equity shares. Non-financial assets, these are the financial assets. Okay, these are the financial assets 1 and 2, and these are the non-financial assets. Non-financial assets should be based on the highest and the best use. Physically possible, legally permissible, financially feasible. Is it physically possible means, see, when you are talking about the non-financial assets, is it right? Non-financial assets, we have to see, when you are talking about property, plant and equipment, we are taking into consideration what? Depreciation. Is it right? We are taking into consideration what? Depreciation. What we will take into consideration, what we will take when we are talking about intangible assets?
Amortization.
Amortization. Five quarters purchase 100%. Is it with this? Is it? Good. Five quarters. This is the last one. Okay. 5 quarters are purchased 100% of ordinary shares of 3 halves and is trying to determine the fair value of net assets. 3 halves owns land currently developed for industrial use. The fair value of the land is how much? 5 million. Land is a which type of asset?
Non-current.
Land is a which type of asset?
Non-current.
Non-financial asset. Is it right? Land is a non-financial asset. This is where I say that's very important. Is it right? Non-financial asset, property. We should not use non-current assets. Okay. This is the difference. You have to come out of that mindset. Okay. When you are talking about IFRS 13, you should say that land is a non-financial asset. Okay, this is non-financial. What is the fair value of the land is how much? The fair value of the land is 5 million. See, how should the fair value of the land be determined? Here they are asking us very clearly how we are going to determine. What is the current value? The fair value of the land is how much? The current value of land is how much? Current value of land is 5 million. Is that now? Currently developed, the owns land that is currently developed for industrial use. Many nearby plots have been developed for residential use at high-rise buildings. The land owned by 3 halves does not have planning permission for residential use, although permission has been granted for similar plots of land. The fair value of 3 halves of the vacant land for residential purpose is how much? 6 million. See the thing. Now see, this is what happens. Okay, this is what happens. You will have, see, you have purchased land somewhere. Is it right? You have purchased land somewhere. Nothing has been developed here. Is it right? No development is there. The moment you will have some development, automatically what will happen? The price of land will increase. Is it right? The moment there is a development is taking place, what will happen? The price. You have invested with how much? You have invested with 5 million. Now there is a development is there. When there is a development, the price of the land will the fair value of 3 halves land as vacant site for residential development is how much? It increased to how much? It has increased to 6 million. Is it right? It is going to be increased.
Yes.
Now, very simple common understanding. See, it's not difficult. SBR is not difficult at all. Only thing is concepts you understand. If the moment you understand the concept, you can apply this anywhere. The transformation cost, is it? The transformation cost is how much? 3 million. What we have done in the previous case, we have deducted transport cost. Is it right? We have transport cost. Why we deducted? Because transport cost is directly related. Cost is directly related to the product. Understand my point? Directly related to the product. Yes or no? You are somebody is you will say free delivery. Is it a free delivery for any seller?
No.
No. Is it? It's not a free delivery. Is it? You may they will either they will charge from the customer or they have to pay from them. That is the reason. The transport cost is directly related to the product. This is the reason. This is the reason why it has been deducted. Now it is more clear. Is it right?
Yes.
Is it? No, why it has been deducted. Whereas transaction cost is your obligation, your choice. You can have a broker or you cannot have a broker. Okay? You wish to have a broker, you don't wish to have a broker, you are buying a land, you take a legal advice, fine, risk is less. You don't take legal advice, the risk is more. Okay? That is the reason transaction cost is kept separately. Now what it has been said that if you are taking a 6 million, how much is there? The transformation cost. Means would need to be incurred to get land into this condition. When you have a transformation cost, how much is the transformation cost? 0.3 million. It comes to how much? It comes to 5.7 million. Is it right? It comes to how much? This 5.7 million is going to be identified as a fair value. Are you okay with this?
Yes, sir.
Okay? Is identified as a fair value. Okay? Fair value of is a fair value of financial instruments. We will cover in chapter 12. We'll go in detail. Is it? For time being, just we will make it a. We will stop here. Okay? Are you clear about this? What we have discussed?
Yes, sir.
We see this is very important. The moment you want to revise it, is it? The moment you want to revise it, you have any doubts on that, just go through this file. Automatically what will happen? Things will have more clarity. What we have discussed now, I am going in a sequential manner. We are talking a basic concept of the financial report conceptual framework. We have only touched, we have not gone in detail. Okay, we have not gone in detail about the things. We are talking about the elements. Then we say that how it is going to be faithful qualitative characteristics. Is that when you have to recognize, when you should not recognize, and subsequently we move. That is the fifth half of the concept. The second part is we are focusing on IFRS and how the IFRS is going to have its application with respect to financial reporting. Is it okay with you?
Yes, sir.